Welcome to In the Balance, the podcast to help you build your dream team of experts to make your financial goals a reality.
Oh, g'day, how you going? It's Phil Tarrant, co-host of In the Balance podcast with the crew over at KHI Partners, Munzurul Khan, who many of you will know and like and probably even use him as your accountant. You can go and tune into our original episode when we launched In the Balance, and that was me pretty much saying I finally got him to come out of the shadows as my accountant and start talking about what's going on and how to do things better, and he's done that. We're now into our fourth podcast. Munzurul, how you going? Welcome to the show.
Very good. Thank you.
What's been happening, mate?
Yeah, lots of things, right?
Yeah.
There's a whole bunch of noise, and we're sort of going towards the Christmas and sort of the New Year, and the question on everyone's mind is the interest rate going to drop? Are we going to see a bit of a price increase next year? Is it a bit of a noise? Is it a bit of a reality? And whether there would be something extraordinary happens, who knows, right?
Who knows? And we could talk about that today. We're only literally a month and a bit away from Christmas when everything slows down. I know a lot of people will use that time over the break, and I do it myself for some sort of planning for the year ahead and setting the agenda for how you're going about sort of what you're going to buy or what you might sell or what you might be strategizing or prioritising. We'll touch on that as well today. But Munzurul, I know you're a true blue property man, and often probably one of the criticisms I would say about your wealth creation journey is that maybe you're too heavy in property. But, you know, you like to invest in what you know, and there's nothing wrong with that. It's very smart. If you don't understand what you're investing in, I would probably recommend it because I don't provide any advice because I'm not qualified to do. But if you don't understand what you're investing in, my recommendation would be don't invest into it. So you like property, you back property, you invest in property, and property has been favourable for you. But KHI Partners is a very holistic and broad organisation that covers a whole bunch of different areas of wealth creation. We've spoken about it before: accounting, mortgages, all the tax planning and SME type finance for business owners. But it's even broader than that. And you've brought in a couple of your colleagues into the studio today, Stephen James and Max Pagnin, financial planners. Normally financial planners and property people don't mix, mate. What's going on? Gentlemen, welcome to the show.
I'm actually very excited of today's show, and the reason I'm excited is that both of these gentlemen will challenge us quite a bit, and what is the right investment.
Yeah, so welcome.
Thank you. Thank you.
How important is it being diversified, Stephen, as as an investor?
Look, it's absolutely it's critical, really, to be able to reduce risk. Is so important in any investment portfolio. There's a lot of other investments other than just property to be looking at. I love property as well, but I also like a lot of other investments, including shares, which I do like to specialise in.
And I dabble in the share market myself, and I sometimes talk about that. I sort of force myself to invest in shares because I always hear this the person on my shoulder saying, diversify, Phil, just don't do property, just don't do property, find other ways. It's going to be good in the long run. And we'll have a chat about that today, shares versus property and the benefits, the pros and cons of both of them, how you'd be able to use different vehicles like your SMSF potentially to diversify out your portfolio, and really how a financial planner works alongside your accountant. Often it's hard to get financial planners to come in and talk about property, so it's good to see Stephen here. And Max, you're also a financial planner, true blue.
I am.
Dyed in the wool financial planner. Financial advisor, what's the right language? Advisor or planner?
Same, but different.
Okay.
Yeah, no, you can use one interchange with the other, so... but yeah, when you say true blue, I probably don't fit the mould of the true blue financial planner that just specifically recommends investments in the stock market. I do hold a property portfolio, which I've had for a few years now, and it's done quite well for me. And so I am a believer in property for wealth creation, but I do also believe that you should be diversified as well. And shares have a different sort of aspect to property in that they're very liquid, especially close to retirement. That's important. If you need money for a new car or a holiday, you can sell a parcel of shares, but you can't sell a bedroom or a bathroom. So it's vitally important to have that diversification for those reasons as well.
And that's important as you get more sophisticated in wealth creation. I typically find people start gravitating towards a financial plan when they start thinking about what next, right? It's nice to have a whole bunch of wealth tied up in, capital growth in portfolio, but if you can't access it, it's no real good to you. And this is a big challenge everyone faces.
Exactly, yeah. So, I mean, what I've found is some clients are coming in and saying, look, I've got all these properties, I want to retire, and what's next? And then if you dig a bit deeper, depending on the kind of property, some especially you're talking about, it could be apartments or townhouses where there's large strata involved, and you look at the net yield that those properties are paying, in terms of the value of the property. Could that money be invested somewhere else to get a better return? And more liquidity.
And capital growth, in many ways, is just vanity if you can't really get stuck into it. And a lot of people get absorbed and obsessed with the idea of talking about how big their portfolio is. But if it's negatively geared and it's costing you money to hold it, it's hard to retire on that. Yeah. And you also do a lot of work around sort of life insurance and TPD and risk management and all that sort of stuff.
Yeah,
well,
that's
right?
vitally important, especially for property investors. I see a lot of clients that they have all the insurances for their properties, the landlord insurance, the building insurance, everything that's vital in terms of having a portfolio. But unfortunately, they don't seem to have themselves insured. We don't know what can happen. Everything is possible in life. I've seen too many instances where clients have had an illness out of the blue, an injury, and people that are healthy that you wouldn't sort of expect to have things like cancer or a stroke, and then. Thank God they had the policies in place to protect them and their families, so they didn't have to, I guess, lose the family home or sell an investment property. So they are important, and a lot of people just rely on what's in their, standard super funds, and in the 90% plus of cases, it's just not enough.
Yeah, and from what I understand about sort of life insurance and TPD or whatever the benefits are. The earlier you get it, the cheaper it is over time as well, right?
Yeah. See, what happens is, someone says, "Oh, I'll worry about it later." There's a, the old adage, "The she'll be right, mate." That's the typical Australian sort of mentality, not to worry about it, or I'll be okay, nothing's going to happen to me. And then what I've seen is I've had the odd client where, look, I want to take out some insurance, okay, and ask about their medical history. Oh yeah, I've had this and I had that, and it's only because of that event that they then place an importance on it. But then what that means is that potentially they may not get insurance at all, or if they can get it, they have to pay double or triple the price compared to someone who's healthy.
Yeah, and they'll carve out a lot of that stuff anyway, right? So I sort of pay life insurance. I got a couple of policies, and I sit there just going, I'm happy to pay it. They can get expensive, right? Like it's not cheap depending on what you insure for. But we can touch on that. That's sort of a holistic wealth creation thing, sort of estate planning as well. And
exactly.
And estate planning is just not planning for what happens to your estate when you pass away. It's about how do you actually leverage your estate during the period of your time of your retirement. Exactly. But lots of concepts to work through today over the next sort of 40 minutes or so. But Munzurul, inflation data's recently come down, 2.8%. What are you reading, mate? What's going on? How all this information out there right now, how's it helping to shape your property investment decision making?
Yeah, look, I mean, there's quite a bit of data, there's quite a bit of noise, right? So you look into it and you sort of say 2.8%. Then you sort of say, well, it's September 2024. What does 2.8% means? It's a 12 months average, right? Then you look through the individual months. Then you sort of say in the month of September, that month by itself was about 3.1. Prior to that, it was about 3.4. Prior to that, it was 3.8. And month prior to it was about 4.1. So it's sort of progressively dropping quite a bit. And we all know that 2 to 3% is the target that RBA sort of wants to do, right? Their issue with that 2.8 and whether to reduce the interest rate at this stage or whether we hold on to a bit more is because some of the incentive that the government has given recently, right? And those incentive, the government says that if we take away those incentive, then the real level of the inflation is perhaps a little bit higher, whether it's 3.1, 3.2, or whether it's more middle of 3.5. So there is this view that whether next year there is a slight risk, whether the inflation is going to go up a little bit before it goes down. The answer is that, do we know it? We don't know, right? And it's the balance which is the critical bit, right? It's the balance that you don't want to be overdoing it. So you go so far away that you almost get the risk of going outside that 2% or below that 2% risk. But at the same time, you don't want to start cutting the interest rate too early. But what we do read is that whether it is next year, it will drop, and whether it would drop in February, whether it would drop in May, whether it would drop a little bit later on. Again, we don't know because the economics is a bit of a butterfly effect, right? Something else may change, which is beyond our control. Everything gets changed, right? But if you look through and then one sort of says that, it has to go down a bit because the mum and dad's sort of cash is running out now. And sort of we've been hearing quite a bit of a hurting as such. On the other side, with the property side of it, is that we see that some of the rents have started to increase, right? We were speaking a little bit about the Melbourne, and we started seeing some of the things in Melbourne, and even in Queensland, we sort of see anywhere between 4.5% as a return is pretty good. In Sydney, if someone buys a house with a granny flat, we're seeing quite easily about 5% or so return. And we sort of say, well, when was the last time I've seen Sydney at 5%? So in many ways, is that a lot of attributes sort of shows to us that perhaps there is quite a bit of prospect next year, right? And is it going to start in February? Is it going to start in May? And the real timing, no one can do the exact timing, but that's sort of the hinge here.
And I've got a couple of different views on this, and I'll preference this conversation with the basis that we have a pretty, I would say, reasonably sophisticated audience tuning into this. Sure. If you're tuning into this podcast, you're obviously focused on capacity on wealth creation. You're probably somehow dialed in with using property as a vehicle for doing that. So we're not talking to your average mum and dad on the street. We're talking to people who are probably already invested in the idea or concept of wealth creation and therefore being proactive in order to be able to capitalise on it. Now, question for you, the focus perhaps shouldn't be on whether or not interest rates might come down a couple of times next year, 25 basis points or 225 basis points, 50 basis point, right? It's probably not going to move the needle that much for most property investors should that be the case, right? Because there's a whole bunch of other mechanisms and strategies and approaches they can use in order to continue to accelerate the wealth creation journey. It's just not that big. Like I sit there and think, if we got 2 interest rate cuts, it's not going to really make that much difference to me. Is that a normal sort of concept for people who have been in and around property or on a wealth creation journey for a while? Because I'm not redlining. That's the point.
Really good question, Phil. Really, really good question, because there's two of the answer, right? The first answer, which I sort of say is a bit of a short-term view, and the second answer we sort of say that very long-term view. The short-term view we sort of say is that there is an art and there is a science to that decision-making. The science to that decision-making is exactly what he's sort of saying. Munzurul, if there is a couple of interest rate drop, 0.25%, 2 lots of 0.25, maybe just a little bit more, does it really make a difference when we went up all the way from 0.1 to 4.35? We had 4.25% increase over the last 2-3 years, right? So is it really going to make a huge difference? I agree with this. But I think my view is that, and I'm happy to be challenged, right? But my view is that the very first interest rate drop, when it does have it, there would be an enormous psychological impact to it. Is the fact that, okay, it is 0.25%, right? But the fact that it just dropped is that in the average mum and dad and everyone it's sort of almost being solidifying in your mind that it's not so much the drop that we're not going to have any more up. That's the expectation, right? And mind you, that's part of the reason why RBA is probably being careful, is that once we start dropping it, we don't want to go back in terms of sort of increasing. So that psychological impact to me is a bigger impact. The second comment which I want to say is that in terms of short-term and long-term, in the longer period of time, we almost set aside the interest rate side of it. We sort of say that what are the fundamental of the property investments at the moment, right? And what are the fundamentals? And the question is, can I afford to borrow it at the moment? Can I pay the serviceability? If I can borrow at the moment, I would not be doing the maths of sort of 0.5 or 1% decrease. I'd be doing the maths with the current level of the interest rate. I would be adding away a buffer on top of it. I would be reducing my rent. Rather than 52 weeks, I'd be saying, well, let's take 48 weeks as a rent. I would be adding a little bit more expenses, repairs and maintenance, 3-4 grand every year as sort of those mitigating factor. And as long as those mitigating factors works, is that then one can look into the investment. But where we are at the moment is that market is tough, right? I mean, borrowing is harder. We don't have a lot of cash. Bank is sort of struggling to meet that serviceability criteria to give us the loan. Means that who can afford to do it, there is a lot of bargaining power. But last comment which I want to say, also market within market. Like you look into Perth as an example, gone through quite a bit high, right? You look into Adelaide, also did well, right? Brisbane market is relatively strong, but I'm sort of finding Sydney market is nowhere near as strong historically as it was. right? And of course, Melbourne market is sort of there's so much opportunity.
Yeah, quite a lot of points you've made there, Munzurul, and I think you sort of echoed the sentiment of your more sophisticated investor or your more proactive investor isn't really making investment decisions based on whether or not interest rates are going to come off by 1 or 2 times or 25 basis points twice in a year. And that's the best way to be doing it. You shouldn't be making investment decisions on, absolutely redlining for a point in time and hoping that rates come down. And serviceability is still in place. That's been debated through the Senate and other aspects over the last couple of months that APRA is happy with the 3% buffer on top of all mortgages. Now, to your point around mindset and the sentiment around we'll start moving into a downwards rate environment once that first interest rate cut happens. That's going to change a lot of people's psyche and those people who have been potentially sitting on the fence waiting for it. But I still would argue that's probably not your proactive investor. They've been investing through this period irrespective and sitting around waiting to start investing in property should there be a 25 basis point reduction to mortgages and that accelerating the market. I don't know. The jury's out for me on that point.
Yeah, you make your individual decision, right? You stay with your goals and sort of you stay at your long-term goals and you stay true to your long-term goals. You have the mitigating factor behind it. Is that whether we say interest rate drops, so you don't budget on that interest rate drop, right? You say as it is, whether we can sort of purchase this. And as long as you stay true to your goals, and this is where your diversification comes in, this is where your longer term retirement planning comes in, right? And staying within your goals. And
the point that Max made, property isn't very liquid, whereas other asset classes are very liquid, particularly sort of shares and bonds or ETF or whatever you want to invest in. And this is the benefits of actually having a more holistic and wider view towards longer-term wealth creation. So you're thinking about your risk aspects of it as your insurances, your structure, so how you choose to hold your assets. Your accountant can help you out with that as well. But then also what other what asset classes do you invest in outside of property? And I think a smart investor has a holistic view towards that. So you've brought a couple of people in the studio for us to work this through. Stephen, tell me about your debates with Munzurul about why he doesn't invest outside of property more than what he does. And we're all friends here, so.
I think Munzurul has he's got a very good strategy with property and the way he's going about building his wealth. Everyone's different. You've just got to be basically sticking to your lane and working with, what you're used to. For me, I love, as I said, both property and shares. But for Munzurul, maybe the share side of things doesn't work for him particularly well. But I love that aspect of my portfolio because I've worked in that space for a long, long time. So I just know it, and it just works for me. You've again, as Munzurul said, you've just got to be thinking about your own goals and objectives, and working along to what is going to work best for you over a longer period of time.
Yeah.
And it's great to have property, but I'm slowly trying to convince Munzurul that shares is also another area we should definitely be looking at for him and his portfolio.
Keep working on it. And what is it, do you think? Is it nothing ventured, nothing gained, or have you been burned, Munzurul, in shares, or you feel as though you have greater control in decision-making with property?
I think it's not. To me, the debate is that it's not so much the shares and the property, right? It's sort of they both can do exceptionally well.
Sure.
They both has their own level of positivity, right? Your diversification, the liquidity, and sort of your flexibility in terms of moving as opposed to trying to sell a kitchen, right? You can't sell a kitchen, right? So we get that, right? So it has this. On the other side, we sort of say that, yes, there is a capital growth, compounding impact, and yes, there is this bank borrowing as such. So using other people's funding, you can say that, well, we can use the margin calls and there is a lending as well. So there is an argument to both. But I think my view is that you stay to something which you understand. And I think the only reason I haven't invested in shares so much at this stage, I don't have enough knowledge on the shares. And if I were to understand it, I would be investing, right? I've got clients who are just purely on shares and they would not have any property outside the principal place of residence and the holiday home. And they've done very, very well.
Yeah.
Right?
And very mature thinking from your side. you're highly invested personally in property, and that's where you work with a lot of your clients, on myself included. But you don't want that to dilute the actual value of KHI Partners, where you can actually be holistic and service all clients, irrespective of where their appetite is or where their intention is for different asset classes. Do you run across a lot of people like Munzurul, Stephen, in your day-to-day, where they sort of go, I only want to do this and that's the only thing I'm going to do? And I imagine that's the challenge, but also the opportunity of a really good financial advisor is to actually shape attitudes and behaviours and investment decision-making.
Yeah, every day come across people exactly like that. So many of our clients do love property, but you're absolutely right. Being able to shape their mind and change their mindset, whereby they start thinking about other options that are available. And certainly when we're talking about self-managed super funds, that we do a lot, we might be looking at a property, but when we're talking about self-managed super funds, we need to make sure we've got an investment strategy. So that's where the diversification part comes in, and why the share side of things is so important. The other reason I love it, the share side of things and other asset classes other than just property, as Max alluded to, it gives us the ability to move from one area to another, gives us liquidity, and that's so important. But one of the things I love is macro, and I've got a whole bunch of things that I'm about to refute what Munzurul has just mentioned. I agree with much of it, and we have these lovely conversations together in the office. And so I'm going to bring up a few things that I think might be of interest to the audience, and why I love doing what I do. And so I love macroeconomics. Absolutely love it. And when I'm doing my research on macro, I get to start to think about, well, where could we, yes, property is great, but where could we also be looking at to put that money to diversify? So in times like we've got now, and I agree completely with most points Munzurul has presented, and that is, yes, we may well see some interest rate steadiness, shall we say, maybe a little bit of a decrease, but the thing that I'm most concerned about is potential inflation maybe a little bit further into 2025. So that's what I'm really quite concerned about. And when I think about that, it starts to make me think about, well, where can I position my clients other than just property into other asset classes? Where can I weight them so that they can take advantage of what I know potentially macro-wise how things could work out. And so there's certain asset classes at the moment that we just would not go into given a medium to longer term time frame, but certainly a lot of other asset classes that are working particularly well at the moment and that will continue to work well over the medium to longer term.
So let's talk about some of those asset classes which you think look good at the moment. What will they be?
Okay, without giving any
We're not giving any advice at all. So this is where we include the disclaimer, which I'll do. This is just for interested people having a conversation around theories and general concepts when it comes to investing, rather than providing any specific advice.
May I also ask, is that when you sort of say that your view is that in 2025, after whether it's sort of a steady, is that whether there is a risk of that, whether the inflation takes a bounce back, so to speak? I'd love to know a little bit more, because I think that's a massive concern from RBA.
Yeah.
This is probably the only reason, even if it is 2.8, RBA is saying that we don't want to be overdoing it at this stage.
Yeah, so I think the RBA is kind of in a steady hold at the moment. I don't think they're going to be making any rash decision. As you said, there may be a couple of rate drops, but I don't think it's going to have a massive bearing on things, given that, the rates have gone up, so high, particularly in the US. If we look at the US, they've come down from 5.5 to 5%. 0.5% is nothing. There's been so many increases over there. I don't think it's going to have much of an effect. But what we've seen is a disinflation period, and what I'm really concerned about if we have and this is why I don't think there's going to be particularly in the US, I don't think there's going to be maybe too many further drops in the short term. Yes, there may be a little bit further out, but The US is very concerned, and it's already starting to happen. When I look at the bond market is indicating to me that yields are maybe starting to pop up. So the price of bonds is going down, but the yield is going up. So that could relate or translate into maybe later into 2025, where we get maybe a little bit going in the reverse, maybe the opposite, where we've got interest rates actually increasing, but that's further down the line. So coming back to your question, what asset classes in an inflationary environment, I think we're in stagflation at the moment, where we've got increasing inflation but a slowing economy. Hard assets work really well. Mm-hmm. So it could be the ones that Munzurul loves very much, but there's a whole heap of other hard assets, such as various commodities, without getting specific, that one could be looking at for their portfolio. And there's other areas.
You're talking about like stashing gold in a safe or somewhere or other? I'll be specific. Silver. Hey, silver's good.
Well, no advice given, but gold has done very well.
Yeah.
So the gold price is $27.50 at the moment per ounce US. Who knows where it's going to go?
Well,
but
what do you reckon about buying that stuff online and the bloke just arrives on your door with a courier, just gives you a couple of bars? You know, does it make you nervous?
Not for me.
No.
But there are many different ways that you can buy gold, and predominantly. If I am looking at that as part of a asset allocation for a client, we'd be looking at exchange-traded funds. So when I'm putting a portfolio together, I'm using a lot of exchange-traded funds and direct equities, maybe some listed investment companies as well when I'm putting the portfolio together, whether it's for a person or maybe a trust structure, for example, an SMSF.
So I've got it's an important question. If any of these asset classes, say, a bundle of shares or an ETF or whatever, right? Does it really matter if you're buying that in your SMSF or buying it outside of your SMSF? Is the asset still the asset, and you're making those decisions irrespective of the structure that it sits in? Does it really matter that much?
I don't think it matters too much. The thing that matters is the tax. Situation within a SMSF, and that's where you're getting a better value or better value for money, shall we say, compared to if it's held personally. But it depends on the client's objectives and goals. Which way. If they've already got a self-managed super fund, yes, we may use it. But if they're wanting liquidity and they need that money, then possibly we're not looking at a strategy where we're trying to build super and be making contributions to super. We might be keeping it outside of super because they don't want to lock it away. Once it's in super, they can't get at that money until they meet a conditional release. So that's very, very important when we're looking at, where we're placing money.
And the tax rate that is, Stephen, that you are sort of emphasising, right, which is the tax rate is 15%, the capital gain tax is 10%. After the retirement, there is no tax, right?
Yes.
I'd probably also argue that at the same time, it depends on what's the age bracket of the investors as well.
Yes.
Right, who's someone who's sort of a lot closer to the retirement. As opposed to someone, say, 30s and 40s having a self-managed super fund. The whole investment strategy would be very different, right?
Yeah, 100% different. In such a case, you'd be... given that you're close to retirement and meeting conditional release, you can get access to that money. So as Munzurul's saying, if you're a 40-year-old and you needed that money and you put it into super, it's locked away for 20 years. You can't touch it.
Yeah. So there's lots of application ramifications of how and where you invest, and you're talking about other hard assets like gold and other asset classes, and this is the uniqueness of the relationship you need to have with your financial planner. They'll put together a strategy and a sequence that's specific to you. When do you know that you need a financial planner? And I don't have a financial planner, but I know lots of financial planners. So I probably do because I just call them up and ask them what I should be doing. And I've got a pretty good job. I can get all the advice I want for free because I just invite people on a podcast. But when do you know you need a financial planner, particularly if someone's really property-centric?
I think it's when a person's situation changes and they're really unsure as to what they need to be doing. Often we've got clients, or I've got clients coming to me and they basically throw their hands up in the air, have no idea what to do, so concerned about, am I making the right decision? Is there other things I should be considering? So it's really if someone's situation changes, for example, they're approaching retirement, maybe they've come into an inheritance, some sort of a windfall, and they don't know how to handle that money. And more often than not, it's all about the handling of the money. People just don't understand what should I be doing to get the best benefit for me. So it's a change in situation, change in your life, and I think that's the main time I would be seeing a client. Or if there's a change in circumstance, for example, they want to, instead of their retail or industry fund, they want to start a self-managed super fund because they want more control of their money. And they want to do it themselves. So that would be a point in time where their situation is changing, and we'd be looking to talk to them and guiding them and assisting them to do or get put things in the right way for them moving forward.
And it's probably a basic question, but some of our listeners might not know. How do financial planners charge you? How does that work? I imagine you would go see them and you'd have a meeting and they create a statement of advice, and then there will be an ongoing relationship. So that'll be the strategy bit, then there'll be the tactical application of it over time. Is that right?
Yeah. So the initial part would be a strategy. We might discuss the strategy, get the client's current situation and find out exactly where they're at, work out what's most important to them, and then start to work out strategy and solutions to solve their individual problem or achieve their goals and objectives. So that's part of it. We prepare the statement of advice, have another meeting, go through the statement of advice with the client, make sure they're understanding of everything that's in the statement of advice. And, of course, we need to get consent and sign-off from the client before they make any sort of move with what we're proposing as our recommendations. Ongoing, it's important to do reviews. And for myself, most of my clients would have an annual review where we sit down, have a look at the portfolio, whether it's shares and or property. Predominantly that is the case. And then we make adjustments depending on, changes in their circumstances and maybe they've changed the way they perceive risk, and they determine, well, I don't want to take on quite as much risk, so we've got a need to adjust the portfolio to match that level of risk.
So much like a property portfolio, you'll go through different aspects of it or components of it, and by risk, I imagine when you get a little bit older and closer to retirement, you think about preserving your wealth rather than the early doors probably being, hey, let's give it a punt because if I lose or blow on my dough, I've still got time to fix things. So, it's all connected in with it. Well, a lot of property investors have a view, Stephen, and maybe you can give some sense to this, that financial planners traditionally don't recommend property. And this might be a historic perception where financial planners used to be paid commission based on the assets they were recommending, and because property didn't actually do that, they never recommended it. And still today, there are financial planners who might not consider or recommend property. So how do you know you've got a good financial planner is the question, who's actually given you unbiased strategy and tactical execution, because a lot of them aren't property experts.
True. In terms of whether you've got a good advisor, I think it's all about the rapport and how you deal with that advisor. If you feel comfortable with that person, I think that's extremely important. With regard to property, yes, Max and I like property. We've got to be very careful with regards to property. We can't specifically tell a client you should go out and buy this investment, this property, and we would refer to a buyer's agent, so they're the experts in that field. We would look at the strategic aspect of property. For example, in a self-managed super fund, we would look at the loan capability, whether we need to make additional contributions to make the property work within a self-managed super fund. But as far as that is concerned, the property side of things, we're not really, or definitely not permitted to be saying, go out and get this property. But we can talk about the strategic aspects of having property, for example, in a self-managed super fund.
Okay, and you'd want your financial advisor or planner working really closely with an accountant, and the base of this podcast, this sort of A team of professionals across the whole sort of connected ecosystem, which would also include a buyer's agent, a mortgage broker, some other professionals. Munzurul, do accountants like working hand in glove with financial planners? Imagine they've got to be pretty tight and on the same page for the client or the investor to get the right outcome.
Yeah, we do. I want to raise this one point on the back of what Stephen says, right, and sort of also answer this as well. That trust is such a massive factor in terms of everything which we do, everything which any professional does, right? So there is that sort of a biased questionnaire at times in terms of that commission-based and whether there is an incentive on that commission-based. Now, in our practice, when we sort of look into Max as an example, we've been together 6, 7, 8 years, if not more, right? And Stephen, number of years, and they're both being financial planner for many, many years, 30 odd years, if not more, being financial planner, right? So when someone sort of comes over to our practice and sort of goes, is that there is already that level of trust factor which is involved. It's not only to Stephen, it's not only to Munzurul, it's not only to Max, it's all of us together as a KHI partners. And because our vision is, any client comes in, how do I service that client for 30 years? We constantly speak about 30 years of service just to get almost rewire our brain means that we cannot afford to do anything for a short term. Even if that means that we give away a whole bunch of things, we give away the whole bunch of things. In the longer term, it averages out, right? And I think that bit of that trust factor and that bit of that sort of that mutual sort of working together as a long term, it goes a long way. So as an accountant, do we work? Max and I work very, very closely. Stephen and I work very, very closely. And the beauty with our relationship is that we don't necessarily always have to agree with everything. And we respect each other's view, right? And very often we could sort of say, I see your view, I see my view. And you know what? I'm going to go with your view, whether we agree or disagree, because there is a logic on both. But at the same time, what we also say is not so much as Stephen's view and my view. It is about what does the client want. Right? And it's very often we sit down with the client and I sort of say, as an accountant, what is my role? As an accountant, my role is not so much to say to Phil, you must do this. My role is to say, Phil, if you do A, these are the positive, these are the negative. If you do B, these are the positive, these are the negative. So I, as an accountant, I see myself as an information provider. As long as you make an informed decision with all knowing pros and cons, then you make the right decision from your perspective, right? So this is where Max and Stephen and myself, we've got James in our office as well. It's a very healthy discussion, right?
I think that it needs to be healthy, and hence the reason why we call this podcast In the Balance, because the responsibility on the decision making is with the individual, the investor, the client.
Yeah.
And they need to make their decisions based on the best information they can have, and in the balance of things, this is the right decision to make and go down a particular pathway. It's the reason why we called it In the Balance. Max, the whole insurance side of things, often the non-sexy bit of financial planning and asset planning, but probably pretty important at the front end. Most financial, if you've never seen a financial planner before, when you sit down with a financial planner, probably the first thing they'll ask you is, tell me about your life insurance or TPD. It's a starting point.
Absolutely, yeah. And I think, sort of, as I alluded before, we all insure the basics, all right? And I'll give you an example of myself. Last year I had a car accident. Now, thankfully, I walked out of it unscratched. The airbags deployed, so no one in the other car got injured. But the car was written off. Now, if I didn't have that insurance, I would have had to find the money to pay for that for a new car. So, you know, and I got to say, I haven't had a car accident since my early 20s when I was a bit, more younger and a bit...
Doing burnouts, Liverpool Maccas.
Maybe not to that extent, but, possibly not.
No, we've all done it.
Yeah, when you're a young male, particularly, you do silly things. But my point is that, you know, that could have gone a number of ways. You know, you sort of, wasn't my fault. The car come in front of me, decided to turn without indicating in front of me. I put the brakes on, and sometimes it's like that slow motion. You sort of see your life flash in front of you, like, okay, I hope this is not going to end badly, but it could. Thankfully it didn't, but, you know, out of that, I could have been injured. I could have been disabled. Anything could have happened. God forbid I could have not been here. So when you have that experience yourself and you realise, yes, the car insurance is vital, but thank God I also have myself insured. I've got my income protection. I've got my TPD. I've got my life insurance. If something happens, my wife's going to be a happy lady. You know, she'll be comfortable. And I always say to my clients, look, I really genuinely hope that this insurance ends up being a waste of money. I honestly do, because that means you've had a good wicket, a good run in life. I'd rather that you have it though than not have it. There's a saying in the insurance game: what would you rather lose, your home or your mortgage? And that policy allows you to get rid of the mortgage if something like that was to happen. So that's the key. Is like, you know, we no one takes insurance with the thought, okay, I'm going to claim on it, but it's that peace of mind. Now, yeah, when you look at the cost, yeah, okay, I'm paying for car insurance, I'm paying for home insurance. There's really no justification for anyone out there not to have life insurance or income protection. When you put the value on that and what that can provide to your family if something was to happen, it's priceless.
So is life insurance, I can't remember, did you have to opt in or opt out inside of your retail and super fund about 7 or 8 years ago? How's it work? So most people might even have insurance if they've got a super fund, right?
Yeah, look, there was a sort of some changes a few years ago where, especially for the younger people, that they were given the option to opt out because a lot of them, you know, possibly living at home, didn't have the mortgages, and for them it might not be worth it. Nowadays, you know, you find that if your super fund is dormant, where there's no contributions going in, after 16 months they'll notify you, hey, what's going on? Do you want the insurance? And if you ignore that communication from the super fund, then the insurance can drop off. And I've seen cases where, you know, someone thought they were insured, but then they weren't, because they didn't realise that this.
So it's worthwhile checking in on that if you haven't done it for a little while.
Absolutely. So yeah, but sort of coming back to the benefits of having it is, I've got a number of clients where they've claimed on income protection specifically. That's the main one. Trauma insurance is a big one as well. That covers things like cancer, stroke, heart attack, for example, as a lump sum. They're probably the two that you come across the most in terms of claims. I've had a few TPD claims where you know, clients had a disability. One of the clients had a stroke, and she accessed a significant lump sum that helped in terms of paying off the home loan and paying off some investment debt. And it's just about having those choices. Like, having that policy means, you know, you can be debt free on your home, maybe pay off a few investment properties, and then you've got, even if you haven't got your income anymore, but you've got some passive income generated. Yeah, exactly. So you're sort of replacing that income lost by the passive income by having paid off some of the investment debt. And that's the way sort of the conversations over with the clients. You know, how far do you want to go? Like, you know, there's always a point where how much insurance should you have? Is you know, you can go to the nth degree and cover every single bit of debt. But especially as you get older, that becomes quite expensive.
It does if you do a lot of investing,
yeah.
And our insurance provider, he'll contact me every year saying, "Oh, let's do a review and this, that, and the other." And I go, "It's already really, really expensive." It gets to a point where you sort of self-insure a bit, if that makes sense. Like because it just becomes the number gets too big, you know. But how do you know when you're at that point in time when you go, okay, that's enough? Or the other side of things is whether you're underinsured. It's probably the biggest issue.
Yeah, well, the majority of people that haven't come to see me or someone like Steve or James in our Parramatta office as well, that, you know, they generally don't have the right amount of insurance. I would say easily 90-95% are underinsured.
Okay.
Well, they'll have a bit. They might have 200,000 or 300,000 sitting in the industry super.
Yeah.
But then you dig a bit deeper. I've got an $800,000 mortgage, and I've got 3 or 4 investment properties, and I owe whatever $2 million on those, and they got a couple of young kids, and
You're really underinsured.
Yeah. So where's that $300,000 going to get
And
them?
Max, very often on the industry super fund, you've got this default insurance, right? And we know we've got an insurance, but when we go into the default insurance, sometimes we get petrified. I've seen as low as 50 grand as being life insurance, right? And then you sort of look back. And from my point of view, as a communication, Max does my insurance as well. And where, to me, is the value is, and again, the same thing, hopefully we don't have to use it, but where the value is just knowing that it's there.
Yeah.
Knowing it's there, particularly having all those different mortgages.
Is Munzurul underinsured or overinsured? Or is he self-insuring?
Bit of both.
Bit of both.
I'm not going to disclose his financial situation.
No, I don't expect you to.
A little bit of both. But coming back to Munzurul's point, very important. A lot of the industry funds is when you're younger, the default insurance will be set higher.
Yeah.
But then as you get older, it drops off and drops off. Now, if you've still got, especially being a property investors that we're speaking to in our audience here, if you've still got a decent amount of debt when you're 45, 50, you may still want to have the insurance at a certain level. But if you've got that default cover that just drops off, and what they aim to do is that the cover drops off, but the premium stays the same. So you're sort of paying the same amount all the way through your membership with that super fund, but you may need more than what they're offering. So that's why having someone like myself or Steve that tailors the advice to your needs and has the policy that's at the right level of cover. And we review it every year as well, just to make sure you're paying the right amount. But that's paramount, because then at least you know at any point in time you've got the cover that you need for your family. And coming back to your point, okay, how do you know when it's too much? We review. Okay, have your properties gone up? How are your kids a bit more independent now? Like some of them they're working and they're left at the school system and all of that. Do you need to have that much cover, or you've got your assets have gone up? So worst case scenario, you could sell a couple of properties if you had to. But we always start with the concept of at least being debt free on the home. That's your starting point.
Principal-based residence, yeah. And selling off assets is part of being self-insured. It gives you, I guess, the capacity to do that. And you can actually pay for your life insurance through your superannuation through super contribution. So for a lot of people, it doesn't actually cost them, inverted commas, anything, right? They don't see it.
They don't see it, yeah. So they're coming back to the point before, there's really no excuse not to be covered, because you can be having that policy paid for by the super fund. So if your cash flow is a bit tight, because you might obviously be struggling with the interest rates and all of that, then it's important to say, okay, well, instead of not being covered, have it through your super as an option, and we go through the pros and cons of that. But at least that means it's better to have something than nothing, right?
Yeah.
Like income protection, for example, is generally tax deductible. So if it's in your name, you're getting obviously some money back at tax time. But if you can't afford that premium because you've got quite a few investments and the cash flow is a bit tight with the interest rates going up, then maybe for that particular person, having the income protection through super might be the right.
Is there times when income protection don't work, for sort of self-employed people and, those sort of folk? I've always questioned.
Yeah, those who are earning predominantly cash, we can't
protect that.
Can't cover that.
No.
So we can't cover those, unfortunately. It's got to be an insurable income.
Yeah,
so you got to what you're declaring to the tax office is what we can insure. If you got a heavy cash business, then we can't do much.
And that comes back to the point, right? A lot of people who may have good cash, unless they're buying properties in cash, in order to get a mortgage, you need to show to a bank exactly your ability to earn money and generate money. So my phone's going off. So again, a good accountant can help you out with that, because you've got to show profit in order to a lender to actually have the confidence to lend you money, or even if it's margin lending, right? Like it's you can't borrow money if you don't declare any surplus funds.
And I take your comments, which you sort of asked to Max, that in terms of the income protection, and I'd be open that I struggle with the concept. And of course, there is a merit to income protection. Absolutely, there is a huge merit. There's no question to it, right? But I hear the question that you're asking when you sort of say that I'm an entrepreneur, I'm sort of I'm sort of backing myself personally as such, is that whether it is, right? But the life insurance is the one, right? Which is
Life
so
insurance is key,
fundamental.
and I guess that's at the heart of estate planning amongst
Yeah.
all the other strategic stuff you do in terms of the two aspects of estate planning is all the sort of legal stuff around it,
Yeah.
like wills and what do you call them? The
Powers of attorney, yeah.
and all that sort of stuff. Should that require, but then and once that's largely done, it's sort of set and forget. You might need to update it if things change, but then it's how do you actually go about creating the wealth and holding it in the most effective structure so you can leverage or utilize that wealth and then also effectively pass on that wealth.
Yeah, well, that's right. At the end of the day, I mean, and that the insurance can form part of that aspect, because if you've got, say, for example, some properties where they're not divisible, like, or one property's worth quite a bit more, and you've got a couple of children, and if you were to leave one to the other, it's not balanced. We're in the balance here, so you can have an insurance policy to balance that up. So that's another aspect of it.
Insurance policy can balance it up.
Yeah.
And I was chatting to Munzurul before we come on air, and we're having, it was a good conversation around when you start out on a wealth creation journey, you don't, whether it's creating a business or investing in property or whatever asset class you're going to use, it's often hard to think about 30 or 40 years ahead. So when you get started, you're probably going to start in the wrong structure. It's only when you start getting a bit more sophisticated, you start thinking about, oh, this doesn't suit me anymore. I need to create something different. And to offset that, you don't want to be younger and starting off investing, however you choose to do it, and create the most complex structure there is, which is intricate and hard to understand and expensive to hold and all the ramifications connected with it. Munzurul, how do you actually make that call? You must see it all the time.
Yeah.
I know you've sort of, my structure's evolved over the years.
Yeah.
Purely, so I didn't set out thinking that, I was the bloke from Blacktown trying to get enough money.
And you've done well.
But you know what I mean? Like,
Yeah,
but you
100%.
can't really, it's hard to think about.
Absolutely. And absolutely right. And very often the answer is that in the sense of pragmatism, right? In the sense of pragmatism, and that's what our podcast is, in the balance, right? So I hear that question day in, day out basis. I'm buying this particular property. I'm buying this business. What is the right level of the structure, right? And then when we look into the estate planning, do we do a standard will or do we do a testamentary trust? Do we need to go through all the rest of the part of attorney, enduring guardianship? And all the rest of it, right? Or do we just do a very simple him to her, heart to him? All of those questions that I sort of hear very often. And I suppose the way I try to answer is to say that as an accountant is that first question which I ask is that where do you see yourself in 3 years' time, 5 years' time, 10 years' time? And sometimes we don't know, right? But when you ask that question, that by itself, your thought process starts to become that longer term. And very often what we say is that we say that, okay, these are different options. You can go plan A. The cost is very nominal, but you've got all of those varied level of disadvantages, so to speak. You can go plan B, which is a little bit better, but that's what the cost is. You go into plan C, which is the bit more sophisticated structure, right? And then we leave it to the investor to make a decision in between all of those. So again, from us as an accountant, as long as we inform the client with all the information that they have, they make the decision. You're right. Very often I see that a multi-million dollar sort of a business and then you look back and say, oh, the structure is sitting on a silly structure. But in day one when they started, they didn't realize that it would be such a structure as such. But on the other side is that if you start with a massive level of sophisticated structure and you don't utilize it, then you're paying for that cost every year in terms of day-to-day running. Right, so the answer is that how do we balance it?
Yeah, and in the balance is what it's all about. What I've found is that, and what I've seen is that it's easier to scale back a structure than to build out a structure. So if you go too big and wide to start with and it doesn't eventuate, you can always shut stuff down.
Sure.
Which is a little bit easier than trying to create stuff and moving assets and paying tax. I don't know. It's tax.
Right?
But and this is the point. You have so many different masters when you're thinking about organising your financial structure, and I guess the question is where do you sell yourself 3 years, 5 years, 10 years, 20 years, whatever it is. Someone just goes, I want to make a lot of money and then want to enjoy it all and I don't want to leave anything to my children. That is probably going to give you one path. Whereas if someone just goes, look, I'm probably going to live a pretty frugal life, but I want to create assets for the next generation, that will be a very different pathway, right?
Just to give you just one example, right? Just before this podcast, I was speaking to this beautiful lady, and she sort of says, Munzurul, I'm buying this particular land, and I want to know whose name to buy this. So I said, okay, rather than going into this structure, how do we do, what name will you buy? Tell me, what are you planning to do with this land? And she's saying that it's a large land, so would be initially using more from an agricultural perspective, would be leasing as such. Good. What do you see yourself in 3 to 5 years' time? Well, I want to build a whole lot of storage in there. And once I build those sort of a storage, I might get some of the investors to come in and sort of help out in terms of funding, whether it's a money partner, whether it's some level of partnership, build the storage. Good. And then what are you going to do with the storage side of it? Are you going to just keep them as a renting? Are you going to be selling it? Oh, I think I'd be selling some of the sort of a storage side of it over a period of time. Then I sort of asked the question that, well, are you buying that as a funding? Are you borrowing money? Are you using that as cash? No, we got to borrow the money. So I sort of said, okay, so if you look through all of those different information that you've given, what is the right structure in that particular point of time, right? You can buy it on individual name, probably doesn't make sense, no asset protection, and sort of longer term you pay a lot more tax. Now we can go all the way to a unit trust structure on that example. The only benefit on the unit trust structure is that if the new investors start to come in, you can sell the units as such. But on the other side, if you look from a bank's point of view, bank could be less hesitant in terms of lending. Bank could understand more is that if it's a family trust, nice and simple family trust, and it's a self-sustaining on that family trust. And what one can do is that if the money partners comes in, you can have some lease or contract with those money partners over a period of time. So on that example is that after bringing in all of those things together, we made a collective decision that perhaps a family trust with a trustee company is what we do. We leave it nice and simple, and over a period of time, we can make it more complex if we need to.
Okay. Well, there's lots there. We're not going to solve all this today. But I do enjoy talking to financial planners. It's nice. It's the sort of stuff you sometimes don't think about, right? Most people get so absorbed and obsessed with the asset selection and the excitement around it rather than, all the what ifs around it. So thanks for coming in today, guys. I really enjoyed the discussion. Keep at it, Munzurul. It's again, I'm the breadth of the KHI team. I'm very impressed that you just keep bringing in really talented and capable professionals to keep discussion. So I don't know who you're going to bring in next, but we'll work it out.
Yeah, we're very blessed with both Max and Stephen. Thank you.
And then, what's the best way for people to get a hold of you guys? Just Google khipartners.com.au is probably the easiest way to start there.
Either in our admin account at KHI Partners or hello@khipartners.com.au.
Okay, there you go. We're here to first. Well, this is In the Balance. I hope you enjoyed that as we get ready for the Chrissy period. And you might even be tuning into this over Chrissy. I know a lot of people use it as a time to binge on podcasts, particularly if they've got the thing that happens at the end of every year and everyone makes New Year's resolutions and starts thinking about their finances. So it's not too late to see a financial planner. Go and check out the crew over at KHI Partners. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.